Welcome back. Let's get back into chapter three. Believe we were just beginning to discuss cash method of accounting versus accrual. So cash method, it works very much like you think. Generally, income is recognized when actually constructively received, not when earned, and it can be in the form of cash, property, or services. Non-cash items are valued at fair market value. Um, this is what you will see when it comes to individual taxpayers and businesses that are under $5 million in revenue can elect to do cash method. Basically, you don't recognize receivables, payables. You recognize income when it's received. You recognize expenses when they're actually expensed. Um, Big thing with this is prepaid income. Under the cash method, uh, you get prepaid income, prepaid revenue. You would recognize that when it's received. The downside of that is you recognize the income. You have no expenses to recognize to go along with it. That is most often where I will see people kind of get into issues when it pertains to the cash method of accounting. You recognize all this income at once, but you don't get any expenses to offset. Constructive receipt. Income is made available to taxpayers power to drop on it or access it. No constructive receipt if taxpayer has substantial limitations in power to assess the income, access income. The tax benefit rule. Tax benefit rule says owe the tax when you are in the best position to pay it. Going back to prepaid income, you might have to recognize taxes on all this when you doing the tax return, but you are in the best position to pay that tax. You might not be in as good of a position 3 months down the line when you have the expenses to go along with that income. Um, Suddenly you might be, feeling it on the cash side, maybe you're cash light, and you are not in as good of a benefit or a good of a situation to pay that tax. Um, Tax benefit rule says, hey, when you're in the best position to pay this, that's when you owe it. Constructive receipt. The book has some good examples on this, and maybe some of you are familiar with the concept of constructive receipt already. If I'm out of town on December 31st and Joe Schmo says, "Oh, hey, I owe you $100,000. It's a Saturday. You're not here. I'm just gonna slide it into your door." Is that constructively received? Um, I would typically view that as no. I don't. I have substantial limitations. Um, Saturday, banks are closed. I'm not here. I would say that for me, I did not constructively receive that. Constructive receipt gets to be kind of a gray area. Uh, I've seen similar situations in case law that says, hey, you know what? It's a Saturday and the banks are closed. That's too bad. You would constructively receive that. I've seen others that say, you know what? You're out of town and someone dropped this off for you. You didn't constructively receive it. There's another familiar, famous case law. There was a NFL player who, part of winning the Super Bowl, had received a free vehicle, and it had to get shipped over state lines, and there was a big issue as to when did he actually receive that. And if I remember that case right, it's been probably 5 or 6 years since I've been in that one. I believe he lost that case. Um, the courts have decided that, hey, you know what? It's you had constructively received that. You didn't have the vehicle, but it wasn't a substantial limitation. So it's constructive receipt. It's get familiar with it. Understand that it is a kind of a gray area. Exceptions to recognition of income when actually or constructively received. We got series W bonds, farming and ranching income, small taxpayer exception for inventories. Yeah, I don't see a lot of these series W bonds, farming and ranching income. I see a bit of the big one's kind of the small taxpayer exception for inventories. And the flip side of the cash method of accounting, we have the accrual method. Income is recognized and earned when goods and services have been provided, uh, receivables and payables. That's kind of what this is getting at. There's other parts to kind of go along with that. You know, employer share of payroll taxes, that can be accrued. There's a few things that kind of go into the accrual versus cash. Accrual for, most corporate partnership returns that I do, you see that one a lot. The accrual method. Earned is defined as all events that occurred to fix the right to receive the income and amounts can be determined with reasonable accuracy. So the all events, that used to be a three-pronged test. I believe the TCJA has changed some of the wording on there, but the general idea still remains. All events are, it's recognized, there's a benefit to it, and recognized benefit. I'm blanking on the third one. This is why I should take notes. Just understand that, yeah, the all events have occurred to fix the right to receive the income. Exception, prepaid income recognized when received. Exception to the exception. You can defer the recognition for prepayment of goods if tax accounting is equal to the financial accounting. Tax is equal to books. Got tax accounting, you've got book accounting. They can be the same. There can be tax differences. This is saying that if your tax is equal to your book, you can defer the recognition. To defer recognition of prepaid for services, must recognize revenue associated with services provided in year one, and the remainder must be recognized in year two. Items of gross income. We've got compensation, business income, and then gains from sales of property. Capital gains. Gross income interest. Interest, compensation for use of money. I'm sure you're all familiar with that concept. Includes interest revenue from corporate bonds, mortgages, life insurance policies, bank deposits, excludes tax exempt interest, obviously. Exception to recognition of interest income, Series E savings bonds. Let's get into the EE savings bonds exception. Interest income from EE savings bonds can be excluded if taxpayer meets all following criteria. Bonds purchased after 1989 by a taxpayer 24 or older. Bonds must be purchased and can't be a gift. Bond proceeds must be used for tuition and fees, first reduced by exempt scholarships, veterans benefits, education credits, and married couples have to do married filing joint. Can't do married filing separately. Exclusion is completely phased out after taxpayers. That's modified adjusted gross income. You'll often see Maggie. It's like AGI, but it's modified. They back some things out. So $100,800 for an individual and $158,650 for MFJ. If qualified education expenses are less than the principal and interest, then only part of the interest is excluded. Rents and royalties, included in gross income, you would expect. Security deposits are not income if they are refundable. Improvements, I mean, so it's essentially it's a holding, right? It's you give me $100 to hold, I'll eventually give it back to you, meeting certain criteria, but it's not my money. It's your money that I'm holding. So it's not really income because it's not mine. It's yours if you meet all these requirements, that go along with security deposits. Improvements by lessee are not includable into lessor taxpayers' income unless improvements were in lieu of rent, services in lieu of payment. If fair market value of improvements not includable, then lessor has zero basis in the property. And let's stop it there because I think we're going for a little bit here, and we'll continue with our next video. All right, thanks everyone.